I'm Dominic. I write for the Investors Chronicle and for the Financial Times, and I'm looking forward very much to talking to the Lecture Club tonight about how to build an ideal portfolio and also some of my current investment ideas. I think it's important to take a holistic approach to investment strategy. Most people do not take this approach. Most people's portfolios, while they don't put all their eggs in one basket, they don't really put much thought into how many eggs go into the basket, or they throw them all in, and what you end up with is, quite frankly, scrambled eggs in many cases. So tonight I want to talk about some ideas about how you can build a portfolio in a coherent way, and some of the things that you might want to put in it. I'll see that it's beginning to pick up, it's beginning to accelerate, and a lot of people are getting very excited about this. There's double bad news here. Not only is the economic recovery weakest since going back 100 years, it's also the wrong kind of recovery. It is far too reliant on the wrong things. This recovery is massively reliant on particularly consumer spending or consumer activity, and the good parts of the recovery are failing to kick in. Businesses are not investing in the way that they should be, and we're not selling enough overseas. How about at the start of each year you simply divide up the world into groups according to this valuation technique, the 10-year price to earnings. You split them into 4 camps, and you buy the cheapest camp. You buy all the stock markets, which will come to about five stock markets, which are the cheapest of all. And if you've done that over time, I calculate that you would have massively outperformed just buying, holding developed market stocks in general. This is something that has worked very nicely. Funnily enough, just as I've got interested in the strategy, the last couple of years it has actually been the worst. But this year, this particular year, 2013, it has been the best once again. The portfolio stretching strategy that I'm suggesting would have involved doing is selling whenever the price falls below that 10-month average, whenever it ends a month below its 10-month average. That's simple. This is totally objective. We know where this line sits at all times, and we know if we simply open the newspaper or whatever on the last day of the month whether the price is above or below that. You can do that with an Excel spreadsheet. So every time that the market crosses below that line, you sell up and you switch into cash and hold the cash on interest until such a time as the market goes back above that line. Where to buy again? Well, once again, just use that 10-month line. In the 1970s, if you simply made that your re-entry, when the market gets very beaten up like it did here, and then you crossed over there, you would have been along for the ride.